joined by Joe Brusuelas, Joe Brusuelas. I'm so sorry, Joe. Principal and Chief Economist at RSM US. How do you say your second name, Joe? And I'm sorry again.
Brusuelas. And don't worry, Andrew. It took me 5 years to figure that out, too.
Brusuelas. My apologies again. Your reaction to the tidings and the signaling from the Fed today, certainly equity investors not happy.
Well, I take a little bit of a different point of view, I think, than most of your viewers and your investors. I think that we had a prudent pause today. You know, the U.S. economy just continues to outperform. We're on a 3.2% track in the current quarter. And I have reason to believe that we're going to continue along a slightly slower but still very strong path. And it makes sense that the Fed wants to take time to ascertain where the economy is, just how strong it is. They did revise up their expectations on inflation, and we've got quite a bit of change coming in the domestic United States. Expansionary fiscal policy is lower taxes, higher government spending, increased tariffs, and tighter immigration. You know what the Fed's doing here? Is they're giving time for their forecasts to breathe a little bit. There's going to be a lot of changes to it next year, and it's good that they pulled back expectations on rate cuts. 2 rate cuts does seem appropriate at this point of time.
That's interesting. Your interpretation would be it's not that the Fed is anticipating higher inflation next year. They're just giving themselves some space to change course if they need to. That's
right. And, you know, when you look at this, I think the soft landing's now in the rearview mirror. We're ensconced in a mid-cycle expansion. This economy's got room to run, and I expect that it will. So the risks are going to change a little bit. And again, with the new administration coming in, and you in Canada have heard all of the noise of the last 6 weeks. So this is of no surprise that we're seeing the Federal Reserve adjust in real time to what's going to be a pretty healthy pace of change next year.
Is the Fed worried about this rise in the US dollar? It's obviously hard on America's great exporting companies.
Well, you could see that the Fed is signaling to everybody that last mile of inflation to 2% is going to be difficult. If you look at their forecast, they don't even expect an average rate of 2% on their target until 2027. So therefore, a stronger dollar will help that. Now, to the extent that we get tax cuts that turbocharge the economy, perhaps at one point they will be, but remember, they don't have purview over dollar policy. That's the Treasury. And at the heart of the economic populism that's now going to be put into place in the United States, there's an internal inconsistency. You can't cut taxes, narrow the deficit, and not have a stronger dollar, right? What's going to happen is you're going to cut taxes, you're going to inject money into people's pockets. That's going to increase demand, cause the trade balance to widen, and that dollar is going to get stronger. So the administration's not going to be able to have its cake and eat it too, with the internal inconsistencies in its policy framework. And the Fed's going to have to navigate that, which tells me 2025 is going to be a very challenging year for U.S. central bankers.
Just the internal consistency there, I think you said, in some of the incoming administration's policies. Can you just explain that to us again?
Well, the internal inconsistency.
Yeah. Oh.
See, the economic populism wants to narrow both the trade deficit and the current account deficit. You can't do that when you cut taxes and inject more money into people's pockets. All that does is create additional demand, stronger growth, and a wider trade deficit. Moreover, it will attract capital into the United States and create the conditions for a much stronger dollar. You know, if you look at capital flows through mid-2024, the U.S. is attracting 12 times more it's attracting more than the next 12 economies combined.
Wow.
That tells me the loonie is going to get weaker here in the first 6 months, 2025.
Isn't it interesting, before we let you go, the whole world has been pouring capital into America.
It's going to increase too. It's going to fund America's investment deficits. But then again, the United States is in the midst of rebuilding its aging infrastructure and modernizing and hardening its economy. You know, for many respects, this is a very good place to be if you're a global economy. But we're going to get major changes on the other side of that, regardless of what's been happening.
It's interesting, just before I let you go, Joe Biden's, the outgoing president, he has put in some very ambitious industrial policy, the most ambitious in decades, trillions of spending on renewable energy, nearshoring, moving manufacturing back to the US. I guess it'll take decades before we see how that really plays out.
Yeah, it's going to take some time. I'm glad you asked that question. Literally 20 miles from where I'm sitting is a multi-billion-dollar chip factory that's being constructed by Samsung in Central Texas. You should see it. It is magnificent. It's hard not to believe this isn't going to be a global game changer because the United States, of course, is not only modernizing its economy, it's modernizing its military. There's going to be strong demand for those chips from all over this economy, both public and private. And when you're talking about demand inside a $30 trillion economy, that demand is decisively non-trivial.
I'm just trying to think. I mean, America, like other Western countries, allowed its manufacturing sector to erode. We outsourced it to China. We let them deal with the pollution and stuff like that. Is that trend are we really going to see a manufacturing renaissance in America and other Western countries?
Okay, when we talk about manufacturing renaissance, I think it's very important that we're clear here. I'm not talking about the repatriation of supply chains back in the United States. What industrial policy intends to do is to create whole new supply chains in areas that are deemed necessary to national security or to protect those infant industries in generative artificial intelligence and quantum computing. Those are going to change the game over time. But I want to be clear here. That's not going to restore employment for men without a college degree. I just don't see that happening. Moreover, what you will tend to see is new supply chains set up in countries that are in free trade zones with the United States and are near the United States or have very good relations, both in terms of international security and international economics.
It's interesting, though, you refer to men without a college degree. Yeah, we hear that that's a demographic that feels alienated from society.
In the United States, it very much is so. I can see it here in Central Texas just by stepping outside the front door. Employment prospects for those individuals will remain difficult, even in a tight labor market, because of the skills that are in demand. Often these young individuals between 18 and 34 always don't have, and it takes a lifetime to curate very specific skill sets that are increasingly tilted towards high technology, science, and mathematics.
Are women, non-college educated women, are they a little less vulnerable?
A little less. They make up the healthcare, social services, administrative, human resources, and marketing divisions in many companies. The risk to them is not that they're going to have a difficulty finding employment. In fact, we're at a record high in terms of the level of women who will have a job in the United States. It's that as we integrate advanced technology in the production of goods and provision of services, some of those women aged 25 to 54 who work in the administrative field may find their skill sets redundant as the technology can do what they do in a more efficient, more cost-effective manner.
Give us a final thought, Joe, and we're covering loads of ground here. What about young men versus young women in the labor market of the future? Is there a problem with young men? I mean, here's a stereotype. They spend a lot of their time playing video games. Are young women going to be at an advantage in the labor market in decades to come?
All right. So right now, the labor market we're going to have 5 and 10 years from now is predicated on levels of education, educational achievement. There are simply more women in college. They're outperforming men. So my sense is that those men in that 16 to 24 demographic are the ones who are going to have the most difficult time adjusting to the new technology-rich labor sector and economy that's going to drive the U.S. Forward. That's going to be one of the lingering social tensions that perhaps drives political change, but we don't know. We're still a ways off from that.
Thank you very much, Joe. That was great. Thanks for giving us that extra time as well.
Anytime. Thank you.
Joe Brusuelas, principal